Welcome to our second video on Q&A training. The title of this video is Introduction to Dimensional Accounting. I'm your instructor, Mike Tennyson, and I am here to try to explain dimensional accounting to you and to try to make this a fun learning experience for you. This is a production of Homemade Elegance. That means that my dog and I have made these sitting in my living room. Think back to the time when you took Principles of Accounting. And on the first day of class, they taught you what a transaction was. And it wasn't long until you were making journal entries of your own. We were recording the transaction, making two lines of information, and they had three facts. On each line of information, we had the account, the amount, and that it was a debit, okay? And we had, on the next line of information, we had the account and the amount, and that it was a credit. And it wasn't long until you were posting these to the accounts. Posting is basically a sorting process where we took all of the same accounts and put them in the same place. Okay, and we had sales and we put them in the same place, 1,600, and we took all of the debits and then all the credits and we added them up and we came up with a total, and we put it onto the financial statements. We just took the total down from above and put it on the financial statements. And that's the way we did accounting long until we had dimensional accounting. That's what you learned in Principles of Accounting. But I would like to introduce you to the concept of dimensional accounting, which is basically doing the same thing but more. And we call this little demonstration Adventist Accountants Playing Cards. Playing cards. Okay, Adventist Accountants Playing Cards. Okay? Imagine that you have a table, and on this table you had two halves of the table, and one half you had 20,000 cards, index cards stacked up, 20,000 of them. You picked up the first card, and you picked it up, and you looked at it, and it was blank, and you wrote on it $10,000 account 60, and you took it and you put it on the other side of the table. Then you picked up another card, and you wrote a negative 10,000 being a credit, and you wrote account 20. You wrote that on it, and you wrote it, and you put it on the blank side of the table. So now we have two cards over there, and we go and we do a third card and fourth card. So we've got the two cards there, okay, and we do a third and fourth card here. We take the card and we write 20,000 on it and 70. And a negative 20,000 on the next card and account 30. And we do this, and we now have four cards all lined up over on the right hand side of the table. And now, let's say we do it for 20,000 transactions that happened in our organization. It takes a second to see all these 20,000 cards go by, but just be happy that we're not having to make the 20,000 cards. We just have to look at them going by. So we have all 20,000 cards stacked up on the right-hand side of the table, each recording many lines of information about the transactions. Say 10,000 transactions, two cards each. Okay? And someone says, Mac, I'd like you to make a trial balance for me. Now the million-dollar question is, how would we go about making a trial balance? And I'd normally in class make you answer, but since you're not here with me, let's just get the problem lined up here and think about it. We have the 20,000 cards now on this table here, and each one of them have an amount and a debit and a credit and an account. And someone says make a trial balance. Well, the first question we've got to ask is, if we add up all of those cards, we add them up, what will they all total? Well, they're all going to total, amazingly enough, 0. Because for every debit we had a credit, every plus we had a compensating credit. Okay? And what I would do if I had this problem is I would take the card and I would take on my table and I would write 20 and 30 and 40 and 50 and 60 and 70 for the accounts, and I'd pick this card up and I'd look at it and it says, oh, it's account 20, and I'd put it right there. Okay, and then I'd pick this card up and I'd look at it and it'd say, oh, it belonged in account 30, and I'd pick the next card up and it belonged in account 30, and the next card up 40, and then this card 60, until I'd separated every one of the cards in the stack. Okay, and then I would add them up, each of the stacks up. And if I add up the totals if I add up all the totals of all the stacks, they're all going to equal 0. Okay, all total. The total of the totals is 0, and we can make a trial balance here that looks like so. Okay, just the total of the totals was brought over here and written down and equaling 0. And that's basically what we're doing in regular principles of accounting class, just a little different way of looking at it. Now I'd like for us to start the example all over again, and this time instead of just writing the amount and the account, we're going to write the department. If it's a revenue and expense account, we're going to write a department and to show which department made the revenue and the expense. But we won't write that for the balance sheet accounts, because balance sheet accounts are not departmental. So we're just for the balance sheet, the income statement accounts, we write the department, and for the balance sheet accounts we don't write a department. Okay, department's not owning any of the assets or having any of the liabilities. And we do that for the first 2 cards, and now we do it for 2 more cards, and that making 4 cards so far. Okay. And come on, baby, there we go. And now we do it for all 20,000 lines of data recording the 10,000 or so transactions that happen to this organization. And again, we let these cards parade past us, just being thankful that we don't have to sit there and write up 20,000 cards. So the question comes in, someone says, Mac, we'd like to have an income statement by department. So how would you go about making an income statement by department from all of these cards? Well, I think we could do it if we had 3 tables. Okay, and let's see if I can let this go by. It's coming. Okay, it's a little slow there, rendering all those pictures. And we have 3 tables. And on the blank table here, we'll put all the cards, all 20,000 cards. Now, all of those cards, if we add them all up, what will they total? They'll total 0. Okay, we'll pick up the first card. If it's got, and then we can divide it. We can divide these cards and sort them. We could take a card and divide it by department and then by account, or we could take it and divide it by account and then by department. But let's just do it this way. We'll start with department A and B and C and D. Okay, and we'll take the cards and we'll pick up the first card and we'll look at it, and this is, oh, it belongs in department A, and we put it in that stack. We pick up the second card, it doesn't have any department at all, so we'll lay it aside. Pick up the third card, oh, it belonged in department B. Pick up the fourth card, and it belonged in department A, and so forth. We'll sort all the cards, taking the ones that don't have any departments, those are the balance sheet accounts, and sticking them over there. Now, if we add up all of these cards and we add up each of the stacks after we've got them sorted, and we could come up with sort of a statement of the profit of each. I'm not exactly sure what you'd call this statement, but a department of the of each department, the profit. Okay, so department A would have had a profit of, well, let's just look at them. We all add up. You see why they don't add up to 0, because we took the balance sheet accounts out. So the organization's net income is $350,000. Well, why is some of them add up to a positive and some of them add up to a negative? Well, in this case, the ones with negative numbers were more than the numbers with without negatives, of positive numbers, and so they would be the ones with net income. Those are credit. The credits are more than the debits, and here we have the departments with a loss. The debits are more than the credits. Okay, and we've sorted them all out. Now we go back to our tables. Okay, and we've got them all sorted over onto the department table. Now we'll pick up Department A, okay, and come over here, and we have account 50, and account 60, and account 70, all of our income statement accounts, and we sort Department A over here into what accounts were produced, and we'd add those up. Okay, they would come up with the same total, okay, as we had with Department A up here. We had a negative 40 net income for Department A. Here's Department A, but now broken down further into their accounts. Okay, and we could keep doing that for all of the cards, and you can see it doesn't take too much imagination to figure out how we take each stack of each department's card, sort it by accounts to come up with this income statement for each of the departments. Okay, I hope you understand that. And now we're just going to run through the routine again, just to make sure you understand. The principle is there already, but now we're going to take our employee expenses, and not only are we going to break the cards down if they're a income statement account by department, we're going to take employee expenses and code them for the who on the employees. So if we say pay the hospital, and the hospital wrote the check out to Ace Hospital, but it was for Fred, we'll code it for Fred as the person that was the employee that incurred the cost. And so we'll do that for the cards again. We'll just run rapidly through the routine again. And you see here we have two cards. We have nothing about department or who over here on this balance sheet account, because we're only doing it for profit and loss accounts, income statement accounts, and we're doing only employee expenses by who. Okay, we'll do it for two more cards, and there you can see that we've got employee expense for Mary and Department C, and of course nothing over on the balance sheet account that offset that entry. And we continue to go through all of those. And so these are the four cards we've done, and now we do that for all the transactions that happen in our organization this year, and we just let them pile up here, 20,000 cards, and they're coming. And I recently was at Babcock University, and they had 750,000 in a sense 750,000 cards stacked up inside their computer, recording all of their transactions. Someone comes along and says, Mac, I would like to have an analysis of my employee expense by who. Okay, I would like to know who had what employee expense. So in order to do that, we'll take and set up now 4 tables. Okay, and we'll get down here to our tables. There we go. And we have 4 tables. We take our 20,000 cards and we put them all on one table. Okay, put them all on one table, 20,000 cards. Okay, and the first thing we'll do is we'll pick up all of the cards. We'll pick up the first card and we'll look at the card. And if it has a who on it, we come over here and we sort it by Mary and John and Fred. Okay, and we pick up the first card and we put Mary's there, and we pick up the next card, and it didn't have an employee expense on it. It might have been a balance sheet account, or it may have been a income statement account that didn't have a who. We put it over there, and we pick up the third card and give it to John, and we sort this one. Oh, this one belongs in the reject pile. And in essence, what we're doing is filtering out the cards that we don't want. We don't want these cards over here that don't deal with employee expenses. We pick up this card, we put up Fred, and we only look at the cards that have a who on them, or deal with employee expenses, and we filter out the cards that do not have an employee expense on it. And that's a major principle of what we're trying to do in Q&A. We're going to do a lot of filtering. You're going to hear more about filtering, okay? And then we're able to make, and so there's the dog helping out with the barking. I told you that it was between the dog and we made this, okay? And we have each of the employee costs, if we add up just what's in their cards, okay? And we'll go back and we'll sort the cards again, okay? We'll take Mary's stack, and sort it by department, okay? Department A, B, and C. Rather, let's sort them first by account. We have account, employee account 70, 71, 72, and we'll sort them by account first, okay? Just the same sort of thing, add them up, okay? After we've sorted them all by account, we can now look at the account. After we've sorted them by account, we'll have these details, but with further analysis showing each of these categories, okay? The employee account and what was spent in employee expense 70, account 70 for Mary, what was spent in employee expense for 71 for Mary and Tom. It doesn't take too much imagination to figure out how we would sort those cards to have that. And then we could break it out even further and put all the Department A employees on one card and all the Department B, one sheet, and all Department B's employees on another card with their expenses. It wouldn't be too hard to figure that out. And so that is dimensional accounting. We could start all over again. We could start all over again with doing it now with one more dimension, project, for example, inner city evangelism, okay? And we do it by inner city evangelism, where we have department spending, many departments working on inner city evangelism, and we could break it down that away, and further we could just continue adding dimensions that we're analyzing our transactions by. And that is what dimensional accounting is all about. We have several useful tags in our system right now, and you can add more. You can add account, and we have account and period and function and restriction, and many tags that we can use for sorting and filtering, and that is dimensional accounting. So I appreciate you listening, and God bless. And stay tuned for demonstration number 2.